If you're a medical professional wanting to save tens of thousands of dollars in taxes, this video is going to break down the 2 things you can use to majorly move the needle and not just get little small deductions, but make huge changes in your overall tax burden. So if that's the kind of tax savings you're looking for, let's dive in. I'm Kristin Burton. I'm a pulmonary critical care PA, and I became a millionaire at 31 through investing in the stock bond market and real estate. And I've personally used these strategies to save well over $50,000 in taxes. So if that's the kind of tax savings you're looking for, let's dive in. The 2 key strategies we're going to cover are the short-term rental tax loophole and real estate professional status. Now, before we talk about those in general, you have to understand the fundamentals. When you have an investment property, especially in the first year, depending on how you structure things, but hopefully all of the time, you'll end up having paper losses. That means when you factor in the depreciation from your property, all of your expenses, etc., that even though you've generated positive cash flow, meaning the property actually did in fact pay you, the IRS views it as a paper loss. Now, that is not considered a loss that can offset your active earned income from your day job in medicine. Unfortunately, the majority of the time. The IRS has categories of income, and that is a separate category. That is what would be called a passive loss, which can be used to offset passive gains. Well, your job in medicine that spits out your W-2 paycheck, right? That is active earned income. And the losses from real estate don't immediately offset it unless you're doing one of these 2 things, real estate professional status or the short-term rental tax loophole, that actually allows you to take losses, again, not cash flow losses, we hope, right? Paper losses from real estate, and apply them to actually reducing the tax bill from your high income job in medicine. So first things first, short-term rental tax loophole. This requires you to have a short-term rental, okay? So average length of stay, less than 7 days. And this cannot be a personal use property, meaning you cannot use the property for more than 14 days or 10% of all the rental days. This is actually easy for this part to meet the criteria, just play by the rules. If you want to use a short-term rental tax loophole, buy a property for the purpose of using it as a short-term rental, most commonly on Airbnb, right? If you're actually doing that, unless you're promoting yourself predominantly as extended stay, you're going to end up with an average length of stay less than 7 days, and you're going to be able to qualify this for the short-term rental tax loophole. Now, whether or not you're ready to buy any investment property, short-term rental included, is a conversation for another day. We've got other content on planning for that and checklists to go through before you decide to increase the risk that you're experiencing financially by adding additional leverage into your life. But again, different video, different time. Once you've actually purchased the short-term rental, as long as you're going to meet the following criteria, you can convert the cash flowing property that you just bought into a tax saving machine if you follow the rules. So that first rule is, again, average length of stay less than 7 days. Now there's more layers. The key layer is that you have to qualify for what the IRS calls material participation. I'm going to make this really simple. You have to actually do a lot of work for the property. Okay, there's a lot of rules for material participation, but there's 3 that most medical professionals use when saying, hey, I'm claiming material participation on this short-term rental. The first is the 500-hour rule, meaning you put in 500 hours over the course of the year. That I actually have found is pretty hard to do to justify with one single short-term rental, but again, there's 2 others. The next is the one we've personally used. You did more than 100 hours, and that was more than everyone else. So you're gonna have to be tracking not only your own hours, but contractor hours, in order to justify, hey, I did not only 100 hours, but that was in fact more than anyone else put into my property. So if you have a property manager that's doing everything logistically, it's really hard to meet any of these rules, as you can see. The third is significant participation, and that's that your hours exceed 500 over this year and previous years. Now, I think number 2 is the easiest one for medical professionals to meet, And for us, having done this now repeatedly, it's actually been really easy for us to justify with time logs and evidence, despite having full-time jobs, having kids, all the things, right? Now, in order to do any of this, you have to have detailed records. You have to track your hours. There's plenty of apps that will allow you to actually go in and do this. I have put together a whole PDF resource that you can use if you want to execute this. It's free inside the Millionaires in Medicine Club. All you have to do is go below, click the link, you can get in and get it for free. But you'll need something to track your hours, you'll need proof, you'll need receipts, you'll need evidence, right? This is one of those areas that the IRS is pretty particular on how this is executed. And so when we have done this, we have actually prepared with our CPA for an audit before it happens. And we submitted all of the all of the evidence with our tax return so that there was absolutely no question that this was a very valid claim. Now, the next layer of this is that you're going to want to front load your depreciation. And a lot of times that's through using a cost segregation study. So you'll have to find a cost segregator to do that for you. Typically, any good CPA you're working with in this arena can point you in that right direction. Now, I will tell you this. This is something you should not execute, A, without a CPA, whoa, B, without a CPA that actually has expertise in real estate investing specifically. You should not be using a run-of-the-mill CPA for this. You should be using someone who very clearly advertises themselves as having extensive experience with real estate investors. This is true for the short-term rental tax loophole. This is true for reps. And we have some folks we work with and recommend. You can take a look at them if you want. Again, it's all included for free inside the Millionaires in Medicine Club. Just go below, click, and we'll get you access. But any good CPA is going to make sure that this is executed perfectly so you don't get audited, and is going to point you in the right direction of, hey, this is how I would set up your cost segregation. Here are some cost segregators we work with, and put you in line to do this very well. Now, this should be true of all real estate investing. It's unfortunately often not. But especially if you're doing some of these higher level tax strategies, you need to be managing this rental property like a business, meaning you actually have books. You track income and expenses completely separately from all your personal stuff. You keep all the income and expenses completely separate than personal stuff. You, for most folks, will hold this property in an LLC. We've got other content from asset protection attorneys if you guys want to learn more about that. You'll have an EIN. You'll have business bank accounts, and everything will be separate. This is its own mini business. And so when the IRS says, hey, what expenses were directly related to this property, there's absolutely no question whatsoever. It's crystal clear because everything is separate and run well, again, like an operating business, so that all of the books are in order, all of the numbers are there. Now, this is one of those strategies that really requires you to self-manage the short-term rental. But keep in mind, most of the benefit of this is actually in year one, especially if you're doing a cost segregation study, you're pulling that depreciation forward. Most of the huge loss that you're going to receive occurs in year one. And so what will commonly be done is, hey, I'll buy the short-term rental, I'll get it all set up, I'll get it operating, I'll get rentals rolling, I'll self-manage it for the first 6 months through the end of this calendar year. I'll claim my short-term rental tax loophole for this year, and then maybe next year, when the tax savings become less, I hire a property manager. Now, of course, you have to make sure the property cash flows with the property manager, which is a little tricky in this market. Not impossible, but tricky. And so that may or may not be the best option for you, but it is an option. The other thing I will say is running a short-term rental can actually take not as much time as you think. The setup is a lot. The staging can be a lot. Getting all of your systems in place, getting your boots on the ground can be a lot. But once you have everything in place, once you have your, quote, boots on the ground, your cleaners, your whoever else is going to be involved in the day-to-day management, you can streamline and systemize things to where this actually takes hours of your time on a weekly basis and not tens of hours. And so we have, for example, a lot of systems automated to notify cleaners, to notify contractors, to get new supplies for the property, to reach out with standardized messaging to guests. All of that is done without our texting or day-to-day involvement, because that's what allows you to efficiently scale your portfolio and even do that without a property manager. Okay, so that's the short-term rental tax loophole. Again, pretty easy to execute if you have a good CPA on your side and you plan for it from the beginning. The other alternative is called real estate professional status. Again, the purpose of it is to take what would have been passive losses from your real estate portfolio and convert them in such a way that they now offset your active W-2 income from your job. This one requires two people, spouse, partnership, in order to be executed well. The reason is, in order for someone to qualify for real estate professional status, you can't be working full-time in medicine. I'll go over the details in a minute, but you're not going to be able to say, hey, I'm a full-time dentist, I'm a full-time PA, I'm a full-time PharmD, and I'm also qualifying for real estate professional status. You'll find there's some overlap, that this involves tracking hours as well, and the IRS wants to know that real estate is a lot of what you're doing. And so in this situation, a partnership where you have one high-earning W-2 spouse, again, maybe you're, subspecialized surgical PA clearing $200K, maybe you're a dentist, maybe you're whatever, and then the spouse says, hey, I work part-time, I'm a stay-at-home parent, or I don't actually have a traditional employment and this is what I just want to do. The spouse is the real estate professional status person. In order to do this, you need a certain number of doors, right? Or a certain number of units, because again, we have to justify hours. And so this isn't something you can buy your first property or your second property and say, I'm claiming real estate professional status. I've hosted my own CPA on a live event and asked him specifically, hey, how many doors-ish do you typically see people have when they can start realistically meeting the criteria and claiming reps consistently? And his answer was, probably 10 doors. For example, if you're not familiar, maybe that's 5 duplexes or something like that, right? 3 triplexes in a single family, but you have 10 doors. At that point, between tenant communication, management, maintenance, blah, 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 you might be able to say, hey, I meet these hours. So this is not for the brand new real estate investor, but this is a strategy you can employ that saves you even more, frankly, or has the potential to, than the short-term rental tax loophole, because the bigger your portfolio, the bigger the tax savings. Now again, you cannot do this without an excellent CPA that is very experienced with real estate investors specifically. This is not your average Joe CPA. This is someone who has nuanced expertise in this area that you're reaching out to make sure that you meet all the criteria, you're not going to trigger an audit, and you have everything in order to claim this. So you have to make sure the spouse qualifies. What does it mean to qualify for reps? Well, again, this is a basic definition, basic overview. Talk to your CPA more about this in depth. But in general, rule of thumb is 1, the spouse must spend 750 hours per year on real estate, or they have to spend more than 50% of their total time on real estate. And so again, you can't work 2,080 hours a year as a PA full-time and then say, hey, I also work 1,500 hours a year in real estate. IRS is gonna look at you and say, all right, we know you're a hustler, but come on, we don't believe you, right? So if you're a full-time employee, this is kind of taken out of the options for you to claim this. Now, I've talked to different CPAs who have expertise in this area, and I've gotten different answers based on the sources, but kind of rule of thumb, if you're a 0.6 FTE or full-time equivalent or above, you're not going to be able to qualify for this most of the time. You really need to be a 0.5 or below. And so, again, talk to your individual CPA about your circumstances. But being a touch part-time, like dropping your FTE from a 1.0 to a 0.7, probably isn't going to be enough to justify this. You're going to have to be either half-time or lower. So keep that in mind. But again, if you already have a household setup, or one of you guys is a high-income W-2 and you have 3 kids and one of you stays home, this is a beautiful way to lower your tax bill that works well with the scenario that's already working well in your house. Now, what qualifies? There's a very long list. It's very broad, but management, tenant communication, acquiring new properties, maintenance, all of that stuff is going to count. So again, theme here, you're going to have to track your hours. You're going to have to justify that what you're saying is true, that you're truly doing enough to qualify. The bigger portfolio you have, the easier it is to say, hey, I am in fact spending this 750 hours a year working in real estate. Now again, really common misunderstanding, you don't have to have like some type of real estate license or anything in particular like that to qualify for this. There are some professions that by their nature, the work would qualify as working in real estate, but you don't have to have that. You can just be like, you could be a stay-at-home mom, you could be a stay-at-home dad. If you are doing the work, you can count the hours, you can meet the qualification criteria. Pretty cool. Now this can create massive savings. We'll give you a basic example. Let's say like one spouse earns $600K. Now maybe that's not in a PA range, maybe that's a different medical professional, but let's just run the numbers. One spouse earns $600K. The other spouse manages the rental portfolio, claims reps, generates $100,000 in losses. That's going to offset that high income. Now, instead of paying taxes on $600,000, you're paying taxes on $500,000. So if you were in a 37% tax bracket, for example, that would save you $37,000. That's a big deal. Now, if maybe the income's not $600,000, maybe it's $200,000, but you can see if the income's $200,000 and you have a big enough portfolio, you could offset most of that earned income using this strategy. And so it's a really cool accelerated way to build wealth because you're able to take those tax savings, redeploy it, buy more investment properties, right? And you accelerate this process as you go, which creates a snowball effect that ends with you being super rich. Again, I've said it before, I'll say it again. Do not execute without a great CPA in your pocket. This requires experience in real estate investing specifically for your CPA in order to be done well. And so if this is something that you think you might want to do, A, go through some of our other content, go through our checklist on making sure you're actually ready to invest in real estate, and then B, get a good CPA in your pocket early that can help guide you in this process. Now again, all of this is in checklist form, a printable PDF. If you want that, all you have to do is go below, get inside the Millionaires Medicine Club. We'll have it there for free for you so that you can have this on paper to run through and make sure you're following all these rules.